Okay, so you want to own a casino. The lights, the clinking of slot machines at 2 in the morning, a red carpet rolled out under a marquee with your name on it. Free drinks flowing to anyone still sitting at a blackjack table. High rollers flying in on private jets just to lose a fortune in your building and thank you for the privilege. Money coming in every single hour of every single day, because the house always wins, right? You build it, you flip the switch, and the cash just starts pouring in, forever. That is the dream, and it is not entirely wrong. The problem is what happens between the dream and the reality. Because almost nobody who has ever tried to own a casino has ended up owning the version of it they pictured. Some of the biggest, most expensive casinos ever built in America went bankrupt within 2 years of opening. Some casino owners have made more money from a parking garage than from the casino floor. Some of the most recognizable casino names in the world have changed hands in bankruptcy court, sold for a fraction of what it cost to build them, to buyers who understood something the original owner never did. And the house always wins line, the one thing everybody assumes they understand about this business, is actually the smallest and least interesting part of how casinos make money. So let's start with the myth, because you have to kill it before anything else makes sense. Most people think a casino makes money because the games are rigged in the house's favor, and gamblers, being irrational, keep playing until they lose. That is technically true, and it is also almost irrelevant to whether a casino is a good business. The house edge on most table games is somewhere between 0.5% and 5%, blackjack, played with perfect strategy, can be as low as 0.5%, while a game like roulette sits closer to 5.3% on a standard American will because of the 2 green zero pockets. On slot machines the edge is higher, sometimes 8 to 15%, because unlike a table game where a skilled player can shift the odds through strategy, a slot machine's payout percentage is baked directly into its software before it ever hits the casino floor, entirely outside the player's control. That sounds like free money. It is not. Because the house edge only tells you what happens on average, over an enormous number of bets, and in between those averages, real money is flowing out the door in ways that have nothing to do with math and everything to do with real estate, hospitality, credit risk, and marketing. Here's the honest answer, a casino is not a gambling business. A casino is a real estate and entertainment company that happens to have a room full of odds-favorable machines on the ground floor. The gambling is the traffic generator. The actual profit engine is everything built around it, the hotel rooms, the restaurants, the shows, the retail, the parking, the convention space, and increasingly, in modern casino resorts, things that have nothing to do with cards or dice at all. Understanding that one distinction is the difference between owning a business and owning a very expensive, very loud money pit. Let's start with what it actually costs to get in the door. You have 2 paths into casino ownership. You can build one from scratch, or you can buy an existing property. Building from scratch on the Las Vegas Strip today is not a $100 million project. It is a multi-billion-dollar project. The most recent ground-up casino resort built on the Strip, Resorts World Las Vegas, cost roughly $4.3 billion to build. Fontainebleau Las Vegas, a tower that sat half-finished for over a decade after its original developer ran out of money in the 2008 financial crisis, eventually opened in 2023 after a new ownership group poured in roughly $3.7 billion total, including the original unfinished structure they bought for pennies on the dollar. These are not typos. Building a modern casino resort at the top end of the market is a $4 to $6 billion undertaking before you have taken a single bet. And that $4 billion figure does not even include the land, which on the Las Vegas Strip is some of the most expensive dirt in the country. Vacant land along the Strip corridor has traded for well over $30 million an acre in recent years, meaning a resort footprint of even a modest 20 or 30 acres can represent a land cost alone north of $500 million before a single foundation is poured. This is part of why the Strip has not seen many genuinely new ground-up resorts in the last 2 decades. Most of the prime frontage was assembled by a handful of operators decades ago, and anyone trying to enter fresh today is either buying out an existing property or building on the increasingly scarce, increasingly expensive parcels left over at the edges. You do not have to build on that scale, of course. A regional casino, the kind you find off a highway exit in Ohio or Oklahoma or Mississippi, without the resort towers and celebrity chef restaurants, can be built for anywhere from $100 million to $800 million, depending on size and market. That is still not a business a normal person walks into. That is private equity, institutional capital, sovereign wealth fund territory. And before you spend a single dollar on steel and concrete, you need something almost nobody talks about when they fantasize about owning a casino, a license. Casino licenses are not something you apply for online and wait a few weeks to hear back on. In Nevada, the licensing process involves a full financial background check on every major investor, a review that can take a year or more, and application fees alone that run into the hundreds of thousands of dollars before you have any guarantee of approval. In some states, like New York, the number of available commercial casino licenses is fixed by law, and companies have spent $500 million or more just for the license itself, separate from the cost of the building. In Macau, the Chinese Special Administrative Region that generates more gambling revenue than the entire Las Vegas Strip, the government renewed only 6 gaming concessions in 2022, and the winning companies had to commit to spending a combined $15 billion in the region over the following decade just to keep the licenses they already had. And almost none of that $4 to $6 billion construction cost is your own money. Casino resorts are built almost entirely on debt, layered in tranches the same way a leveraged buyout is financed, senior secured loans from banks, high-yield bonds sold to institutional investors, sometimes a slice of mezzanine financing from a private equity fund willing to take a higher risk, higher return position behind the senior lenders. That capital structure is exactly what made the Revel and the Taj Mahal such fast, violent failures later on. When you have financed a multi-billion-dollar building almost entirely with borrowed money, you owe interest and principal payments whether or not a single guest walks through the door. And a property that opens even a little behind its revenue projections can find itself unable to cover debt service within a matter of quarters, not years. Then there's labor, which on a project this size is its own enormous, fixed, and frequently unionized cost. A strip resort under construction can employ thousands of union tradespeople at once, and once the resort opens, a full-scale casino resort can have a payroll of 5,000 to 12,000 employees, dealers, housekeepers, security, chefs, engineers, entertainers, most of them under union contracts that guarantee wages, benefits, and pension contributions regardless of how the casino floor performs that quarter. Culinary and hospitality unions in markets like Las Vegas and Atlantic City are politically powerful and well organized, and a labor dispute or strike threat can shut down a property's ability to operate almost as effectively as a government order can. You are not just buying a building and a license. You are buying one of the largest single-site employers in the region, with all the fixed obligations that comes with. So before your casino has taken a single chip from a single player, you are already 3 things: extremely well capitalized, extremely well connected, and extremely patient. Most people fantasizing about owning a casino do not have any of those 3. They have the fantasy of the neon sign. They do not have the $4 billion, the year-long background check, or the political relationships required to get a license approved in the first place. Let's say you clear all of that. You have the license, you have the building, the doors are open, the slot machines are humming. Now here is where it gets interesting, because this is where the business actually starts to look nothing like what you pictured. The first thing you learn is that the casino floor itself, the part everyone assumes is the moneymaker, is often not even the largest source of revenue anymore. In modern Las Vegas resorts, gaming revenue, the money won from betting, frequently makes up less than half of total revenue. The rest comes from hotel rooms, food and beverage, entertainment, retail, and convention business. MGM Resorts, one of the largest casino operators in the world, has reported years where non-gaming revenue made up over 60% of its total Las Vegas revenue. Think about that. The building that exists specifically to host gambling is, for more than half its income, actually functioning as a hotel and entertainment complex that happens to have a casino attached. Why did the industry drift this way? Because gambling revenue, while high margin, is also volatile and heavily taxed. Nevada takes a percentage of gaming win in state gaming taxes. Other jurisdictions take far more. Pennsylvania taxes slot machine revenue at over 50%, one of the highest rates in the country. A hotel room, on the other hand, is not taxed as gambling revenue. A steakhouse selling a $300 dinner is not taxed as gambling revenue. So the smartest operators in the industry spent the last 30 years building enormous, beautiful, expensive buildings around the casino floor specifically to capture spending that the state cannot touch at gambling tax rates. The Bellagio's fountains, the Venetian's canals, the Shark Tank at the Golden Nugget, none of that exists to make you gamble more. It exists to make you stay longer, spend more on things that are not gambling, and come back next year even if you lost money the last time. Then there is the part of the business that looks the most like gambling but is actually closer to private banking, the high roller. This is the piece of the fantasy that is actually real. Casinos do chase whales, the term for players who bet enormous sums, sometimes millions of dollars in a single visit. But here is what the fantasy leaves out: casinos extend enormous amounts of credit to these players, sometimes without collateral, on a handshake and a credit check, because the whole business model depends on getting them to the table. A casino might comp a high roller's private jet, hotel suite, and every meal for a weekend, worth tens of thousands of dollars, purely on the bet that the player's average losses over time will more than cover it. Sometimes that bet is wrong. Sometimes the whale wins. Sometimes the whale takes the credit line and simply never pays it back, and the casino spends years and legal fees trying to collect a debt from someone in a country where the debt is not even enforceable. Wynn Resorts, one of the most sophisticated operators in the world, has had to write off tens of millions of dollars in uncollectible marker debt from high rollers in single fiscal years. These credit lines, known in the industry as markers, function essentially like an interest-free loan issued on the spot at a gaming table, and collecting on them when a high roller refuses to pay can mean pursuing litigation across international borders, in jurisdictions where gambling debts may not even be legally enforceable in the first place. A casino can win every hand of blackjack it deals for a month and still post a bad quarter because one whale it comped a $200,000 weekend for walked away a winner, or worse, walked away owing 7 figures it never collects. The most glamorous customer in the building is also, quietly, one of the biggest financial risks on the balance sheet. This is also why the last 3 decades of casino development on the Strip have looked less like a gambling arms race and more like a hospitality arms race. Every major operator has spent the last generation trying to outbuild the others on things that have nothing to do with the odds of any game. The Venetian built actual canals with actual gondoliers inside a building in the middle of the desert. The Wynn built an 18-hole golf course on some of the most expensive real estate on earth. Caesars has spent hundreds of millions of dollars over the years securing residency deals with major music artists to fill a theater that generates revenue. With zero house edge involved at all. None of this is decoration. Every fountain, every celebrity chef, every artist residency is a rational response to the same economic pressure. Gambling revenue is heavily taxed and largely capped by how many hours a day a slot machine can be played, but a hotel room, a concert ticket, and a tasting menu are not, and they can be sold to a customer who never gambles a single dollar. There is another piece of the revenue model that looks like generosity and is actually one of the most precise data operations in retail, the loyalty program. Every major casino runs one, MGM has one, Caesars has one, and these are not simple punch cards. When you insert your player's card into a slot machine, the casino is tracking exactly how much you bet, how fast you bet it, how long you played, what you ate, what show you saw, and what room category you booked, all tied to a single profile that follows you across every property the company owns. That data feeds directly into what the industry calls theoretical win, a calculated prediction, per player, of how much the house expects to make off you over your lifetime as a customer, based on your play patterns. Once a casino knows your theoretical win, every comp they offer you, the free room, the free steak dinner, the free show tickets, is not generosity. It is a precisely calculated marketing spend, sized to be smaller than your predicted losses, engineered to keep you coming back without ever giving away more than the math justifies. The free drinks at the blackjack table are not hospitality. They are a customer acquisition cost with a very good return on investment. And underneath all of that sits the piece of the business nobody puts in the brochure, junket operators. In markets like Macau, casinos historically did not deal directly with many of their biggest players at all. They worked through junket operators, essentially independent agents who recruited wealthy gamblers, extended them credit using their own capital, and brought them to the casino floor in exchange for a cut of the revenue. For years this was one of the largest channels of casino revenue in the world's biggest gambling market. Then, in 2021 and 2022, Chinese authorities cracked down hard on the junket industry as part of a broader anti-corruption and capital flight campaign. The largest junket operator in Macau, a company called Sun City Group, saw its founder arrested, and the company collapsed almost overnight. Macau's overall gaming revenue fell by more than 80% from its pre-pandemic peak, and a meaningful chunk of that collapse was not about tourism drying up, it was about an entire invisible layer of the business, the junket system, getting dismantled by a government decision nobody in the industry could control. If you had bought a casino in Macau in 2018 believing you understood its revenue, by 2022 the business you actually owned would have been unrecognizable, and you would have had almost no say in why. What makes the Macau story worth sitting with is how invisible the risk was right up until it wasn't. For nearly 2 decades, junket operators were treated by Wall Street analysts and casino operators alike as a fixed, permanent feature of the market, a distribution channel as reliable as a shipping route or a supplier contract. The 6 companies holding Macau gaming concessions built billion-dollar resorts assuming that channel would keep functioning indefinitely, because it always had. Nobody in the industry's models had a line item for the junket system gets dismantled by the government in 18 months. That is the nature of political risk in a licensed industry. It does not show up in a spreadsheet until the year it happens, and then it is the only line that matters. Before we get to who loses money and why, it's worth pointing out that not everyone who owns a casino is playing at the $4 billion Las Vegas Strip level, and the path you choose changes almost everything about your risk. There is a whole tier below the mega resort that almost nobody pictures when they fantasize about casino ownership, tribal gaming. In the United States, federally recognized Native American tribes can operate casinos on their own land under a different regulatory framework than commercial operators, following a 1988 federal law called the Indian Gaming Regulatory Act. This is not a small corner of the industry. Tribal gaming generates more annual revenue in the United States than the entire commercial casino industry combined, well over $40 billion a year. The economics here are strange and specific. Tribes are sovereign nations, so state gaming taxes largely do not apply the same way, but tribes typically negotiate revenue-sharing agreements with the state instead, and the casino itself is usually built and financed through a management contract with an outside gaming company that takes a management fee, sometimes as high as 30% of net revenue, for a period of years before the tribe takes full ownership and control. It is a completely different capital structure than a strip resort, but it comes with its own version of the same lesson. Someone with expertise and capital gets a meaningful cut before you ever see the profit. Then there is riverboat and regional gaming, the casinos built specifically to comply with older state laws that only permitted gambling on water, a legal fiction that still shapes the physical design of casinos in states like Illinois, Missouri, and Louisiana decades after the laws were relaxed. These properties are smaller, cheaper to build, and faster to license than a strip resort, but they also operate in markets with a fraction of the visitor traffic, competing for a local, repeat customer base rather than tourists flying in from around the world. A regional casino's whole business lives or dies on your ability to keep the same few thousand local players coming back weekly, which means the loyalty program, not the marquee, is the most important piece of marketing you own. Where a strip resort can absorb a slow year by leaning on tourism from the other side of the planet, a regional casino has no such cushion. Its entire customer base can often be found within a 30 or 40-mile radius, and if a competitor opens a newer, shinier property one exit down the highway, that customer base can shift almost overnight. And increasingly, there's a version of casino ownership that requires no building at all, online and mobile sports betting and iGaming licenses. States that have legalized online betting since 2018 have created an entirely new, much lower capital path into the industry. Companies can operate under a licensing arrangement tied to an existing land-based casino, without ever constructing a physical property. This has been reshaping the industry's economics in real time, and it is also, as you'll see shortly, one of the biggest threats to the value of the physical buildings the old-school operators spent billions constructing. So who actually loses money owning a casino, and why? Let's talk about the Revel. In 2012, a casino called the Revel opened in Atlantic City, New Jersey. It cost approximately $2.4 billion to build, at the time, the single most expensive building ever constructed in the state of New Jersey. It was designed to be a new kind of casino, glass towers and a beach club aesthetic aimed at a younger, wealthier crowd than the traditional Atlantic City gambler, deliberately built with fewer slot machines and less of the smoky, low-ceiling casino floor feel of its neighbors. The developers believed they were building the future of the industry. The Revel filed for bankruptcy less than a year after it opened. It filed for bankruptcy a second time about a year after that. In 2014, after burning through more than $2 billion of construction and operating capital, it shut its doors completely. In 2015, the building, which had cost $2.4 billion to build 3 years earlier, sold at auction for $82 million. That is not a typo, and it is not a discount. That is a 97% loss on one of the largest casino construction projects in the history of the East Coast, in under 4 years. What went wrong tells you almost everything you need to know about this business. The Revel bet its entire design on a customer who did not show up in the numbers the developers had projected, a younger, non-gambling focused, lifestyle-driven visitor who would spend on rooms and nightlife rather than slot machines. But Atlantic City's overall market was shrinking at the same time, as new casinos opened in Pennsylvania and New York and pulled gamblers away from the New Jersey shore who used to have nowhere else nearby to go. The Revel had also negotiated an unusually generous tax break to get built in the first place, one that assumed a level of revenue the property never came close to hitting. It had 4,000 employees and a payroll that assumed a full building, and it almost never had a full building. Every single assumption in the original business plan, the customer, the market, the tax structure, the occupancy, turned out to be wrong at the same time, and in a business with this much fixed cost, being wrong about even one of those is enough to sink you. Being wrong about all four in the same building is why a $2.4 billion tower sold for $82 million. It's worth pausing here to look at the other end of the outcome, because the same industry that produced the Revel also produced one of the most successful bets in modern casino history, and the difference between the two tells you exactly what separates a good casino from a bankrupt one. In 1998, Steve Wynn opened the Bellagio in Las Vegas at a cost of roughly $1.6 billion, at the time the most expensive resort ever built. Critics called it reckless. The fountains alone cost tens of millions of dollars and generate zero gambling revenue on their own. They exist purely as a marketing device, a free show visible from the strip designed to pull foot traffic in the door. But Wynn built the Bellagio around an insight the Revel's developers never fully grasped. The property was designed from day one to be a luxury hospitality brand first and a casino second, with art galleries, 5-star restaurants run by real celebrity chefs under long-term partnership deals, and room rates that competed with the best hotels in the world rather than the cheapest ones in Las Vegas. The Bellagio was profitable within roughly 2 years of opening, and by the time Wynn sold his company's stake in the property's parent company years later, the valuation of what he built had multiplied many times over his original investment. The building that started the modern era of Las Vegas mega-resorts did it not by having better odds on the slot machines, but by correctly identifying who its highest value customer actually was and building every square foot of the property around that person, years before the Revel tried and failed to do the same thing 80 miles up the coast. This is the part of casino ownership the fantasy never shows you. The downside is not proportional to the upside. A casino that succeeds might generate a healthy, steady return for decades, the kind of boring, reliable cash flow that makes institutional investors happy. A casino that fails does not fail a little. It fails completely, because almost every dollar spent building it is sunk into a single-purpose building that cannot easily be turned into anything else. You cannot convert an empty casino tower into an office building or an apartment complex without gutting it down to the studs. The Trump Taj Mahal, once the most expensive casino ever built when it opened in 1990 at a cost of over $1 billion, filed for bankruptcy within roughly a year of opening, and the property changed hands, restructured its debt, and eventually closed for good in 2016, its name later stripped off the building entirely. The pattern repeats across the industry with startling consistency: colossal, market-defining construction costs, followed by a debt load so heavy that even a modestly disappointing year of revenue is enough to trigger default, followed by a bankruptcy court deciding who actually ends up owning the thing you thought you owned. There is also a slower, quieter risk that does not show up in any single dramatic bankruptcy filing: regulatory and political risk. Because a casino requires government permission to exist in the first place, the government retains enormous leverage over it for the rest of its life. Tax rates on gaming revenue can be raised. New licenses can be granted to competitors just down the highway, instantly cutting into a market a casino spent decades building. Smoking bans, changes to comp regulations, restrictions on credit extension to gamblers, every one of these can be altered by a single piece of legislation, and casino owners have essentially no ability to stop it beyond lobbying and hoping. You are not just in the hospitality business and the entertainment business. You are permanently, structurally dependent on the goodwill of whichever government granted you the license to operate, for as long as you own the building. There is also a risk that almost no casino owner had priced into their models until it happened: a government simply ordering every casino in a jurisdiction to close, with no notice and no end date. In March 2020, every casino on the Las Vegas Strip shut its doors by state order because of the coronavirus pandemic, some of them for the first time in their entire operating history. Properties that had run 24 hours a day for decades, with debt loads built on the assumption of continuous revenue, generated close to zero income for months while payroll, debt service, and property taxes kept accruing. Some operators survived by drawing down enormous credit lines and furloughing tens of thousands of employees. Others did not survive the shutdown in their existing ownership structure at all. It was a reminder that a casino, no matter how well run, is fundamentally a building that depends on the government's continued permission for people to walk through its front door, and that permission can be withdrawn overnight for reasons that have nothing to do with how well you ran the business. And there is a newer, slower-moving risk eating at the value of every physical casino building right now: cannibalization from the very same online sports betting and iGaming licenses that make casino-adjacent businesses cheaper to enter. Every dollar a customer bets from their couch on a mobile sports betting app is a dollar that did not walk through a casino's front door, did not book a hotel room, and did not order a $30 cocktail at the bar. Regional casinos, the ones that depend on repeat local players rather than tourists, have been especially exposed to this shift, since their core customer is exactly the demographic most likely to simply open an app instead of driving to the property. Several regional gaming markets have reported measurable, sustained declines in local casino floor traffic in states after mobile sports betting was legalized, even as those same companies' online betting revenue grew, meaning the industry is, in a sense, competing against itself, cannibalizing its own most expensive asset, the physical building, with its own cheapest one, an app. Layer onto that a slower but very real legal risk: gambling addiction litigation. As the industry has gotten more sophisticated at using data to identify and market to its highest value players, some of those same high value players are, by definition, the ones with the most severe gambling problems, since heavy, frequent, high stakes play is exactly what both a whale and a gambling addict look like from the casino's side of the ledger. Regulators and lawmakers in multiple states and countries have moved to impose stricter responsible gambling requirements, mandatory intervention protocols, and in some cases direct liability exposure on operators who continue extending credit and comps to players showing clear signs of problem gambling. This is not yet a business-ending risk on the scale of a Revel-style bankruptcy, but it is a cost center that barely existed 20 years ago and is only getting more expensive, in compliance spending and in legal exposure, as the years go on. And then there is the oldest risk of all, the one baked into the entire concept of the business: you are, at scale, betting that math beats human behavior, forever, without interruption. Most of the time, over millions of hands and spins, it does. But most of the time is not the same as always, and a casino with insufficient reserves can be badly hurt by a run of bad luck on the house side, particularly with high-stakes players making enormous individual bets where a single outcome can swing millions of dollars. This is why serious casino operators carry enormous cash reserves and sometimes even buy insurance against catastrophic single-event losses, the way an insurance company reinsures its own risk. The house always wins eventually. It does not always win this week. Put all of that together and you start to see why the list of companies who successfully own multiple large casinos is so short, and why it barely overlaps with the list of billionaires who tried and failed. It takes an enormous amount of upfront capital just to be allowed to compete. It requires getting the identity of your core customer right on the first try, because a building this size and this specialized does not have a second act. If you guess wrong, the Revel could not quietly pivot to a different customer the way a restaurant can change its menu. It requires managing a credit book of wealthy strangers who owe you money with no meaningful collateral. It requires staying on the right side of a government that can rewrite the rules of your entire business with a single piece of legislation, in a market you may not even operate in yourself, the way Macau's junket crackdown reached into buildings the Chinese government does not directly own. And it requires all of that holding up simultaneously, year after year, because the fixed costs, the debt, the payroll, the property taxes, the union contracts, do not pause just because one of those variables goes wrong. So if you do decide you want to own a casino, understand what you are actually signing up to buy. You are not buying a room full of slot machines with a house edge that quietly mints money while you sleep. You are buying one of the most heavily regulated, most capital-intensive, most politically exposed businesses in the world, one where the majority of your revenue will likely come from hotel rooms and restaurants rather than the tables, where your biggest customers are also your biggest credit risk, where an entire invisible layer of your business can be legislated out of existence by a foreign government you have no relationship with, and where a single wrong assumption about who your customer is can turn a $2 billion building into an $82 million auction lot in under 4 years. The casino floor is not really the business. It never really was. The casino floor is the lure, the bright, loud, unmistakable signal that tells the entire world a building exists where money changes hands. Everything that actually keeps the lights on happens around it, the hotel tower filled every weekend, the restaurant that books out 6 weeks in advance, the convention center hosting a trade show that has nothing to do with gambling, the parking structure charging $40 a night to guests who never touch a card table. The slot machines are almost a cost of doing business, dressed up as the main event. The real asset was never the odds. It was the building, the license, and everyone's willingness to walk back through the front door one more time. That is the actual bet you would be placing if you ever owned one of these buildings, not a bet on any single hand of blackjack, but a decades-long bet that people will keep wanting to gather somewhere loud, bright, and slightly out of the ordinary, and that you can keep the government, the unions, the lenders, and the whales all satisfied at the same time, for long enough for the building to pay for itself. Most people who dream about owning a casino are really dreaming about the fountains and the neon. The people who actually make money owning one are the ones who understood, long before construction ever started, that they were building a hotel company first, and just letting the world assume it was something else.